The stock market is chaotic. For investors trying to build long-term wealth, the daily swings and unpredictable storms make finding a reliable foundation difficult. That is why so many portfolios rely on SCHD. It is widely considered a cornerstone of dividend investing, trusted specifically for its emphasis on stability. Every March, this fund undergoes an internal audit known as a reconstitution, rebuilding its holdings based on strict rules. In 2026, the shift was significant, triggering a 30% turnover, swapping out 22 stocks for 25 new additions. Look closer at the companies being removed. Several, like AbbVie and Halliburton, were exiting the fund after a year of strong upward momentum. Meanwhile, many of the newest additions, such as United Health and Abbott Labs, were entering the portfolio following recent price drops. This creates a curious puzzle. Why would a top-tier dividend fund sell off its recent winners to buy companies that the market has been punishing? The answer lies in the mechanics. There is no human manager making emotional guesses about which sector is due for a comeback. SCHD strictly follows the rules of the Dow Jones U.S. Dividend 100 Index. It runs entirely on an automated mathematical formula. To even be considered, a company must prove 10 consecutive years of dividend payments. Miss a single year, and you are immediately rejected. Next is the liquidity check. A minimum market cap of $500 million and an average daily trading volume of $2 million filters out the rest of the vulnerable candidates. The survivors then face the final quality screen. Here, they are ranked on 4 strict metrics: cash flow to debt, return on equity, total yield, and their 5-year dividend growth rate. When an iconic company leaves the fund, it simply means its underlying data points no longer align with these specific mathematical benchmarks. We can see this algorithm in action by comparing one of the dropped stocks directly against a new addition. This chart tracks dividend growth. The line climbing steadily represents the energy sector's average growth of around 4%. The flat line is Halliburton, sitting exactly at 0% dividend growth over the trailing 12 months. Now replace Halliburton with a new addition, United Health. Its dividend growth rate shoots up past 12%, backed by a 24-year payout history. This same pattern repeats across the 2026 reconstitution. High-performing energy and tech stocks like Cisco and Valero were removed as their dividend growth cooled, while healthcare giants like Abbott Labs and Qualcomm were added. Because the fund requires high dividend growth and low debt, it naturally rotates into high-quality companies that have recently become cheaper. This process effectively forces the portfolio to buy into sectors that are currently undervalued. By strictly adhering to these 4 quality metrics, the fund functions as a systematic machine that rebalances into value whenever the market fluctuates. Building generational wealth requires a long time horizon. Even with these new additions, the fund maintains a baseline yield of around 3.5%, while using the reconstitution to improve its overall safety metrics and balance sheets. Let's run a Monte Carlo simulation. Investor A chases growth, facing chaotic drops. Investor B relies on dividends for a smooth curve. If A drops 20%, it needs 25% to break even. B's reinvested payouts create uninterrupted compounding. The strategy prioritizes preservation during downturns, a focus that allows it to outpace aggressive growth funds once the full market cycle completes. Once you understand the mechanics, an annual reconstitution stops being a reason to panic. It serves as proof that the system is working exactly as intended. Over a lifetime of investing, a disciplined strategy will defeat emotional trading every single time. What are you planning to do with your shares of SCHD? Let me know down in the comments, and make sure to like, share, and subscribe for more deep dives into the strategies building your wealth.